Hello everybody, welcome to today's vlog. Today we are going to talk about how to double your money, and this should be doable in a relatively safe and completely legit way. Okay, so in order to understand that, let us first see how the calculation should work to achieve our goal. Okay. So let us begin with the amount that, and let us say that we have $100 available with us. So if you have a different amount of money, you can of course adjust accordingly. Consider this as 100% in your case. Okay. So now let us try to put year zero is when we have $100. That is before we uh, begin any activity. Okay. So now, let us say we find the interest, uh, we find a tool which can give us annual return rate of 7%. That means it will give us $7 back on $100 in 1 year. Now, which are those tools we will discuss after some time in this session. But for now, let us say that we have found that tool, we have identified that tool, and we are capable of getting 7% as interest. So on year zero, we will have how much we will have added from interest. Let us say we are just beginning. So for first year, it is zero, and the total at end of year is equal to this plus this is equal to 100. Now this is just our beginning year. So if we have placed this amount at 7% interest for the next year, so at the end of year one, right? At the beginning of year one, we will have $100. We will earn 7% interest on this 100. So we will earn $7 by the end of the year. So at the end of the year, we should have $107. Okay. Now let us say we take this $107 and reinvest it for the next year. So year two, we will have $107 to start with, and then again we get this 7% interest on it. So 107 into 7 by 100, we will have $7.49 in interest. So 107 plus 7.49, we should have uh, uh, we should have $114 at the end of the second year. Now let us proceed with year 3. So again we begin with $114 at the beginning of year 3, right? So we would have $114 to begin with, and again we are able to get 7% interest. So this into 7 by 100, we will have $122 at end of this year. So this is the power of compounding interest, right? And I'm going to proceed. And here the understanding is we reinvest what we get back from the interest at end of the year. Now at year 4, let us say we reinvest this $122 and we get 7% interest on the same. So we get $131 at end of the year. So as you see, it's compounding again and again. We take this $131 and at end of year 5 we will have $140. So to begin year 6 we have $140 to begin, and if we take 7% interest on it, we have $150 at end of the year 6. So as you see, we have from $100 which we begin, at the end of sixth year, we have accumulated 50 more dollars. Now, again, if you see that this is a very slow process, yes, however, this is a legit and relatively safe process. And uh, I'm not claiming that we will be able to double our money within a week. If the process has to be safe and legit, it does take a long time, right? And the idea of presenting this video is many people do not know how to do this in safe way, even though they are okay to wait for long term. And that is the purpose of making this particular video. Okay, so now let us say year 7. Let me try to, okay, have some more years added over here. Okay, so let us bring this here. So at the end of year 7 we have 160. At the end of year 8 we have 171. At the end of year 9 we have 183. At the end of year 10 we have 196, which is almost double. And at the end of year 11 we will have 210, which is more than double. So basically what this means is, if I want to increase my $100 to almost double, at the 7% interest rate or 7% a year return rate, it will take me around 11 years. Okay, now instead of 7%, if this was 8%, of course this will be a little faster, right? And instead of 7%, if this was 6%, this would be a little slower. So now let's keep this as it is, and let us try to find out um, how much how this would be different if this was 8% instead of 7%, which is just a difference of 1%, right? So let us say we begin with 8. I'm going to change all this calculations here. So we are trying to calculate with 8% instead now. Okay, so we have just increased 1%. We have uh, increased it to 8% instead of 7%. And if we see in the same period of time, which is 11 years, our amount available to us will be $230 instead of $210. And if you see within 5 years or 6 years, where it was going to be $50 more, here now it's $58 more. So as you see, even with just 1% difference, the amount change or difference of amount increased drastically or tremendously. If instead this was let us say 6%, let us try to calculate that as well, just to set some perspective. If this was instead 6%, and of course, as we said, this assuming reinvesting of the dollar amount. This is the power of compounding interest, guys. So if you see, it was 1% less instead. Even at year 11, instead of having $210, we just have $189. So as you can see, 1% makes big difference either in the side of increase or in the side of decrease. Okay, so I hope this gives you a perspective of how the money can double. It will take approximately, let's say, 10 years at uh, 7 to 8%, right? Uh, so now that we have cleared the calculation, let us discuss that how we can get this kind of return. And of course, I mean, this is a relatively very safe way to get return. If you want, there are more riskier ways which can give you much faster return, way faster return than this. But these would be not as safe ways as the ways we are going to discuss. So now that we know the calculation and the calculations are clear, that for 7 to 8% we have to wait for around 10 years with the compounding interest, so to safely and legitly double our money. Now let us see which are the ways we can do it, and we will discuss the percentages of those ways around it. Okay, so these are three main ways in which this can be achieved. First is bank, right? So depending on which country you are in, depending on which country you live in, or depending on which countries you have access to, the banks give percentage return. So if you are, for example, in USA, and the maximum return you may find in a bank is somewhere around 2%. Now, not all banks would give this to you in US. Certain larger banks would just give you 0.5% or 0.1%, right? 0.1% to 2%. Uh, but again, you have to compare this with 7%. So if 7% takes you 10 years, 2% to 0.1% is take the number of years is going to be way more. You have seen how the percentage varies, right? Now, if you are uh, right, if you are in other countries, let us say South Africa, India, Sri Lanka, or one such developing countries like that, the percentage return is usually in the range of 7.5 to, it varies. I mean, on a good year, it can also be 10%. So now, if you live in a country like that, or you have access to the banks of countries like this, you can invest at a much higher percentage of return, which is 7.5 to 10%, which will almost guaranteedly and safely double your money within 10 years. But if it is around 7, but if you go around 10, it might end up to be around 8 years, right? So this is the way to double your money safely and legally. Of course, you have to wait for a long time. However, this is practically uh, low to no risk bet. The only risk which you are carrying is if that particular country or if that particular bank defaults or has some issues, right? Other than that, these investments are considered relatively safe. So let me also write risk, country or bank defaults, right? Uh, so that is option one. Other risk which you carry, let's say if you live in USA and you want to invest in a country like India, or if you live in some other country, let's say UK, and you want to invest in a country like South Africa, the other risk which you carry is currency fluctuation. So today one US dollar may be equal to 10 South African currency, but you wait for 1 year, you get a 7.5% interest, right? And then due to the currency fluctuation, the 7.5% interest is equivalent to just having 2% interest, right? So in that case, you are uh, talking of currency fluctuation, which will impact your ability to earn this return, and also the transfer charges and legalities of this transfer when you are trying to do this multi-country transactions. These are not necessarily allowed for everybody in every countries, so you have to be you have to dig down on those directions, find out the legalities, find out what are the transfer charges when you're transferring from one country to other and back. So those are the risk components, especially in the multi-country environment or multi-region environment. Okay. The other option which we can do in US is basically the CDs. So if you go to any investment site, I don't know if all the investment sites offer it in the country of USA, but I've known from my sources that larger investment sites like Fidelity, etc., would offer something called a series, and which usually have interest rates varying between 2% to 7% depending on the risk you are willing to take. These CDs are explained on these websites very well. You can also give a call to their representative and they will walk you through this in more detail. Uh, to my knowledge, the smaller websites or free trading websites, etc., may not offer these options, but usually banks or larger companies would offer these options. So that is one very good way to invest, which is relatively safe. Of course, there is relatively more risk as compared to invest in a bank in this, but again, it is likely to give you relatively higher returns. So basically, again, CDs are riskier. Some of the CDs, their rate fluctuates. So in order to get a certain percentage of interest rate, you may have to pay certain amount of money, and the money which you originally invest in may also fluctuate. So you have to be careful. CD relatively risky than bank, but uh, but you can work with it. Okay. So with diligence. So do a little diligence. Go and read about this cumulative deposits or CDs, and there are some government CDs also which give around 3%, etc. So try to read through it and invest accordingly. The idea of this discussion is to give you a high level on what ways are possible, and then you can of course dig down, or we can do more episodes on those, right? Uh, and the third option is stocks. Now, I'm not saying buy the stocks to which will give you, the return you wait and the stock price goes up. I'm talking of dividend stocks, right? So, of course, this is relatively higher risk, but if you consider stocks like Duke in US market, it will give you around 4% return, right? If you consider stocks like GO or good in US market, which will give you around 10% return. And if you consider stocks like let's say Microsoft, it gives you 1% return. So you have to understand the stocks. Now note that it does not mean just because the stock gives higher percentage dividend, it is a good stock. You have to uh, make sure that fundamentally the company is okay. There is a way higher risk as compared to the above two methods here. Uh, for example, your stock may give you 10% dividend, but your stock price may go down to around 15% and thus causing you the net loss, right? Now, as far as the stock price is going to come back from 15% to almost to what you invested, you are okay. But the risk remains that you may end up losing money instead of making money when you are going for stock. So my suggestion is, even though you get relatively less percentage return, choose stocks which have been relatively stable over years, and by that I mean around 20, 25 plus years. The prices relatively remain stable or at least flat, and in that case, even if they are giving lesser return like 6% or so, it is okay, right? Make sure the company is fundamentally okay before you go towards this investment. So these are just my thoughts. I'm sure people who are watching it, if you are a little more learned, you may have some or experienced in this area, you may have some more thoughts of your own, and you might be able to tell us some more ways to relatively and safely double your money over a long period of time. So like, comment, subscribe, and tell us your thoughts. Let us try to discuss and evolve together. Thank you so much, guys. Have a wonderful day.